Good morning, everyone. Thank you for joining us today. Welcome to our first presentation in our IUL series with Francisco Umaña joining us from AIG. I know none of you are here to listen to me talk, so we're going to jump right in. But before we do, if you have any questions, please put them into the chat box on the right-hand side of your screen. We'll make sure they all get answered at the end of the presentation. And afterwards, feel free to give us a call to get a copy of today's webinar as well. So with that, thank you all again for joining us today, and I'm going to hand it off to Francisco.
Good morning, everyone. Thank you, Sean, for the opportunity here. And as Sean mentioned, this is the first of a series of IUL webinars that we're having with our jetter. The next one is going to be next Tuesday, and then the third one will be the following Tuesday. So then let's go ahead and begin. So this webinar is called, as you can see right there on the screen, Comparing GUL and IUL Guarantees, the Argument for IUL. So what this webinar is going to consist of is making that, exactly as it says, making that argument for an IUL. I know there are a lot of agents or a lot of consumers out there too that may be fixated just on GUL, and this is definitely not a knock on GUL. I mean, GUL is still a very good product. It may be, as you can see down here, the best choice for some clients, but at the same time, an IUL may actually provide some of the same guarantees as a GUL and still have more options, more flexibility, and also more significant cash value. So what we're going to talk about today, we're going to talk about the guarantees on our GUL product and our protection-based IUL product. We're going to talk about how the markets affect the GUL or an IUL. And then I'm going to do an introduction into the 4.5% story sales idea on our Value Plus Protector IUL. That's our protection-focused IUL. So why do you sell GUL? Well, it's permanent. If you want long-term coverage, or you just would be selling term, it's guaranteed. You know right away it's a guaranteed premium and death benefit up to a certain age. And it's easy. It's easy to illustrate, easy to explain. You just tell your consumer, hey, if you just pay this fixed amount of premium on time every year, no other amount, then the death benefit is going to last out to this age that we chose. And I'm just going to say to age 100. That's the example I'm going to use. So now thinking of IUL now, it's permanent, just like a GUL. Now about guarantees, yes and no, but that can actually be a really good thing, and we're going to hit on that in this presentation. And is it easy? You might realize that it is. It's not as difficult as you think it may be. I know a lot of people, agents and consumers alike, may think that an IUL may have too many moving parts. Oh no, it's too complicated. How am I going to explain it? It's not. It's not as complicated or as many moving parts as you may think it does have. So before that, I do want to just go a little bit into the background. Something between a GUL and IUL, a way to think about it is that it is all universal life. The UL actually happened, that came into in the 1970s as an alternative to underperforming whole life policies. So clients wanted a way to maybe get a little bit more out of a life insurance policy, maybe have more flexibility with their premium. So now they wanted, the UL came out in the 70s, but then clients realized, okay, I want to maybe a little bit more. How do I get even more out of a UL? So then in the 80s, a VUL came out. It's a way to take advantage of booming markets because a VUL actually, the funds of premiums you pay in actually participate in the market, so there's great potential there. But then with a VUL, we don't know how the markets are going to perform. They can go up and they can go down. There's volatility there, a lot of volatility that some clients or agents alike just may not want. It may be too much for them. So then GUL was a response. They wanted something that, okay, they want to have that peace of mind knowing that, hey, I got a guarantee here. And then that's when the 2000s, GUL came out. But we're, of course, we're in the life insurance industry. Everything keeps changing. Everything keeps innovating. So then in the 2000s, IUL, an accumulation-focused IUL came out. But now what happened here is it's not a VUL where the money is actually in the markets and you can lose principal. This is actually downside protection, so you won't actually lose anything, but you have that upside potential. But then sometimes with an accumulation-based IUL, you're not getting that guarantee that you may want, but you still want cash accumulation. So what can we do to solve that? So then now here the protection focused IUL is the most recent product innovation where it's actually combining the best of both worlds, where you can have comparable guarantees to a GUL, but then you can also have the cash accumulation component that an accumulation focused IUL may have. So that's a little background right there, just giving you an idea how we ended up where we are right now. So definitely the protection IUL spaces, which it's very popular right now. People really do like that they can, in fact, get a little bit both worlds. And it's a way that if you're an agent that just is in the GUL space, a protection-focused IUL, that's really a great way to go ahead and get your feet wet into the IUL space rather than just going straight to the deep end of the pool with an accumulation-focused IUL. So GUL and IUL, as I mentioned, they're all IUL. They're all UL. It's all products, all universal life. They're built on the same chassis. So think of universal life coverage as a drive to the top of a winding mountain road. For the example, we're going to start at age 50. So we're starting at age 50, and think about the most permanent coverage as taking you to the summit, to the very pinnacle of your coverage, which in this case is age 121. But something to consider, though, to look at things from all angles, is that the higher you go, the steeper the climb. A gallon of gas doesn't go as far later in the trip. What that's saying is, as you're getting more and more later into the later years of an IUL, the cost of insurance goes up. So now that's where this climb gets steeper. The gallon of gas here is the premium. So the premium that you're paying in now, let's say at age 80, isn't going as far as it did at age 50, because at age 80 the cost of insurance is higher. So now that climb is steeper. And you notice that it gets even more steeper on there. But in any case, every policy still has a beginning, and that's where the gas comes in. That is the premium. You notice, and that's the accumulation account. But sometimes the premiums alone can't take it all the way to the very top. So what do we need? It's interest. So that's when IUL hits right there to take it further than that. But sometimes, though, interest crediting isn't enough to get you to the top either. So an accumulation account may run out of gas. The accumulation account, that's the cash value on there. But if it runs out of gas, what happens then? Well, in a GUL and also in a protection-focused IUL, there's actually another tank, a spare tank, that's called the continuation guarantee account. What this is, those are the guarantees. That's the pricing that's built into the policy. That with the premium that you're paying, you're funding this account so that you have those guarantees on there, so you have that peace of mind. So as it says right there, this CGA will ensure that the policy doesn't run out of gas before reaching the desired guarantee age, which in this example, we're going to use age 100. So those are the two gas tanks we're going to think about for these policies. The continuation guarantee account, those are the built-in guarantees, and then the accumulation account, that's the accumulation value that also allows the policy to extend a little further than what you thought it may have extended to. So what AIG products have this CGA account, this continuation guarantee account? The two products we're going to compare today, the Secure Lifetime GUL 3, along with the Protection-Focused Value Plus Protector IUL. So let's compare the two options. So right here, you're going to see that for this example, we're going to use a 50-year-old male, preferred, non-tobacco, on a 20-pay, same annual premium, same death benefit. So we're going to use them on a $1 million death benefit. They're going to pay for 20 years, $14,000 a year. Then you're seeing here that on GUL 3, the guaranteed to age with that guarantee continuation guarantee account, it goes out to age 100. On the Value Plus Protector, it goes out to age 90. You notice right here that this is saying the Value Plus Protector is getting a rate of return of 5.85%. Well, this age 90 is actually not bringing this rate of return into account. It's only going on that one gas tank, the CGA account. But now if we actually start bringing this into account, the 5.85%, you notice as the GUL 3, it still runs out at age 100 because it still only has that one gas tank, that CGA account. Value Plus Protector, it doesn't. It still may run a little bit further than that, and we're going to get into that just in a moment here. Something else to look out for: the cash value year 20 on the GUL 3, $16,000. Value Plus Protector, $425,000. So it's a nice little difference there. That's just a huge difference, right? So definitely that's part of the get the conversation started on how IUL, protection-based IUL, you notice that the guarantees aren't too far off, but now you're getting something a lot more than you would on GUL 3. Look at a death benefit at age 101 on the GUL 3 is zero because the policy has lapsed. We had it to go out to age 100, so after 100, that's it. That's the end of the policy. Value Plus Protector may still run after that. Death benefit at 101, $2.7 million. Death benefit at 121, $9.7 million. Is zero on GUL 3 because it ran out at age 100. But what I want to take a little closer look at is these guarantees right here. As I mentioned, that the age to 100 on the GUL and the guarantee to age 90 on the Value Plus Protector is still only on that one gas tank, the CGA account. So how does the market impact these two options, a GUL or a protection-focused IUL? So now the secured GUL 3 has that one gas tank, a lot of that one gas tank, the continuous guarantee account, but it doesn't have a lot of the second gas tank, the accumulation account. The Value Plus Protector IUL, the protection-focused IUL, has less on the CGA account. It's not a full-blown just guarantee-only product the way GUL 3 is, but you'll see here that the second gas tank, the accumulation one, has a lot more. So remember, think of these products as having two gas tanks on it because that's what they do have. It's just the GUL 3 has a lot more of the CGA account, not much of the accumulation. The Value Plus Protector still doesn't have that much less of the of the continuation guarantee account, but it has a lot more of the accumulation account. So the impact on the market. With a guarantee out to age 100 in GUL, in a 0% market, the policy still lapses at age 100. In a market of 5.85%, the policy still lapses at age 101. So that's telling us that the market performance has no impact on a GUL because a GUL actually doesn't participate in any type of market at all. But now in the Value Plus Protector IUL, remember, using the same premium and death benefit in a 0% market, the policy lapses at age 90. If we actually get a rate of return of 5.85%, which is a very conservative number, the policy matures at age 121 for 9.7%. Oh, excuse me, 9.7 million. So you've given your client very comparable guarantees, but you've given them a huge amount of more death benefit and also some cash value as well. But now this 0% market, we're going to get a little bit more detail to see what that actually means. What is that saying? The market does have a huge impact on the policy, on the IUL. And the 0% comes into play with that. So what does it mean to have a 0% market? So the Value Plus Protector, it follows the indexes. In this example, we're going to use this in the S&P 500. Now with an IUL, we know that it's downside protection and upside potential. That is what makes an IUL very popular. That we know that if the markets go down, there's a negative year, then the client isn't going to lose anything. The most risk they run is that they're not going to gain anything. So if a client gets zero, that means there was a negative year on there. So if that means that if the index goes negative 10, negative 20, negative 50%, whatever it is, if it's negative, the client knows that the worst that will happen is that they'll get zero crediting. They won't actually get anything, but they know they have that peace of mind knowing that they're not actually going to lose anything. So now, in the example that we mentioned, it's a 50-year-old male. In order for it to just go out to age 90 on a 0% market, just using that one gas tank that I mentioned to you, that continuation guarantee account, the S&P will have to generate negative returns for all 40 years. So that means you have to have 40 straight years of negative returns in order on the Value Plus Protector to actually the policy die out at age 90, which is unheard of, is unprecedented. We haven't seen that. So let me give you a little more insight into that. How often has the S&P 500 returned to negative? Since 1927, in the last 90 years, the S&P has returned 29 negative years, so 32% of the time. So how about consecutive negative years? The most consecutive years happened during the Depression years, 1929, 1932. Okay, so what is the worst 30-year period? Even in the worst 30-year period, when you could count for negative years and positive years, the client still got 2.8%. So that means the fact that they're getting something above zero, in this example where we're saying the Value Plus Protector only goes out to age 90, the guarantee, it may actually go further than that because you're already getting something above zero. The second you start getting something above zero in a rate of return, that is going to favorably impact the guarantees on there. There has never been a 30-plus period of negative results. And so in this example, this client is 50. The guarantee is going on to age 90 on the Value Plus Protector. That means the client has to get 40 years of consecutive negative returns in order for that to actually die out at age 90, which has never happened. As it says right here, in the recorded history of the S&P 500, there has never been 30-plus years of negative results on there. So if we look at it from a graph point here, consider the worst markets in U.S. history. Okay, even the long depression back in the 1800s, it still only had 6 years of down markets. The Great Depression, 1929, 1939, 10 years are mostly down markets, mostly being the key word here, meaning that it wasn't 10 consecutive years of negative returns. So the dot-com bubble burst in the early 2000s, it was 3 years of down markets. And then most recently, about 10 years ago, the Great Recession, it was 3 years of down markets. But once again, you didn't go through this huge extended time frame of negative returns. So how bad does it have to look for it to get a negative year return? This is the entire 90-year history of the S&P. As you can go from 1928 to 2008, you'll see that, yes, there were some negative years in that time span. There were some positive years, but what you're not seeing is that there's huge, long stretches of just red. So in order for this example that I mentioned to you, where at age 50, the IUL runs out at age 90, this is how the graph is going to have to look in this example that I mentioned to you. The returns have to look like this for a 30-year period, a 40-year period, in order for that policy to run out at age 90, meaning that for 40 years there's zero return, which has never happened. In this entire history, all the depressions, all the recessions that our economy has gone through, there's never been anything remotely close to this. So once you start getting something above 0% on an IUL, that's already favorably impacting the guarantees on there. So now, guarantee still too conservative? While the market's history cannot be used to protect the future, a 30-plus year negative return in the S&P 500 seems very unlikely. So that's what you can tell your clients right there if they're very apprehensive or reluctant about an IUL. Well, what if the markets don't perform very well? Well, Mr. and Mrs. Client, you have to have decades of negative returns, of consecutive negative returns in order for this to run out at age 90. In order for you to have a guarantee of 40 years, all this has to happen, which has never happened before. The moment you start getting something above 0%, it's favorably impacting the guarantees. So, if 0% for 30 years, as I mentioned, is unprecedented, and if the current illustration rate on the Value Plus Protector, which is 6.32%, that's still not quite conservative enough for your GUL clients, then what conservative rate should we illustrate for your clients on the Value Plus Protector? So here's where I'm going to introduce a story that we have. It's our 4.5% story. That is where we're going to stress down the Value Plus Protector to a rate of return of 4.5%. And you're going to see how it actually stacks up against our GUL product. So let's start to look at the 90 years of the S&P 500. Here's a little bit closer view of what we just looked at a second ago. As I mentioned, you see from 1928 to 2008, there's red, yes, but there's not a consecutive red. There's not long stretches. There are positive years on there. So now let's locate the worst 30-year period in that history. 1920 to 1957 is the worst 30-year period. And as I mentioned earlier, even in that worst 30-year period, right here from 1928 to 1958, when you account for all negative years and all positive years, the client still got a return of 2.8%. So that already is going to further the guarantee of age 90, because once again, that age 90 in the Value Plus Protector is assuming a 0% return, which we're not getting. We're getting a return of 2.8%. So now, let's assume in that 30-year period that we have a cap of 9% on the Value Plus Protector. So now with an IUL, though, remember that an IUL does not take negative years into account. It only takes positive years. If it's a negative year, the client simply gets nothing. That's the worst that can happen, which makes IULs very popular. So in that worst 30-year span, taking negative, only positive years into account, it still gets a return of 4.5%. So what if we use that rate in a Value Plus Protector, the protection-focused IUL? Okay, so here is what we looked at earlier. This is what the GUL, how it stacks up against the Value Plus Protector, getting a rate of return of 5.85%, which is still conservative in itself. But now, what if instead of using 5.85%, we use 4.5%? You'll notice same face amount, $1 million, still paying $14,000 a year for 20 years. That one gas tank we mentioned, just that one gas tank, the continuous guarantee account, goes out to age 100 on the GUL, goes out to age 90 on the Value Plus Protector, but now at 4.5%, you see the GUL still runs out at age 100, but stressing down the Value Plus Protector to the worst 30-year span in the history of the S&P 500, you'll notice it still goes out to age 112. Look at the cash value. $16,000, year 20, $364,000 on the Value Plus Protector. Death benefit at age 101 for the GOL 3, 0, because the policy has lapsed. Value Plus Protector, 4.5%, $1 million at age 101. There's 0 at age 121 because it did go out to 112, but it still ran out longer than the GOL 3. But this is stressing out to the worst 30-year history. This is far down we can stress down. If you get anything more than that 4.5%, let's say 5.85%, you'll see that this policy goes out to age 121, face amount of $9.7 million. So something that I want to mention here is that with a GUL, a lot of agents and a lot of clients may fixate on, well, I want the guarantee. I want that guarantee to age 100, and that's all they fixate on. But that's just it. They just fixate on that guarantee. Someone mentioned what the guarantees are of GUL from a different perspective, and when they mentioned that to me, it really just blew my mind. It really changed the way I looked at GULs. GULs, while they do have that guarantee to age 100, there's a couple of other guarantees it has that we don't think about. The guarantee that a GUL has is that it's a guarantee for low cash value, and then here's the big one that really changed it for me. It's also guaranteed to expire. So on this GUL 3, you know that it goes out to age 100, so you know you have a guarantee to age 100, but you also know that it's going to expire at age 100, and that's it. You have nothing more after that. So here's where I mentioned at the beginning of this presentation, this conversation, that the Value Plus Protector may not have a guarantee, but that's where it comes. That's a good thing. So in this example, if we just use that one gas tank, the continuation guarantee account, 0% return, we know that we have a guarantee to age 90, but that doesn't mean that it's a guarantee to expire at age 90. That's what a big difference is right there. If we get anything over 0%, you now know that it's going to go beyond age 90. And if we stress it down to the 4.5%, the worst 30-year history in the S&P 500, it goes out to 112, longer than a GUL policy. You're paying the same exact amount of premium, but you have a longer duration on the guarantees, and you have much more cash value, which offers your client a lot more options, a lot more flexibility. Once they're in those retirement years, if they need to take out funds from a life insurance policy, they can definitely do that with a Value Plus Protector, IUL, but they can't do it with a GUL 3. So that's really the conversation right there that you can tell your client. To sum it everything up right there, you tell your client, hey, we have a Value Plus Protector, it has comparable guarantees to a GUL. But the thing is, there is no guarantee for this to expire. The way on a GUL 3 is there is that guarantee for an expiration. So remember, GUL 3 is guaranteed to expire, guaranteed to have low cash value, where a protection-based IUL doesn't. You can get the same or even a better guarantee than a GUL, but you also have this huge cash value component to it. So here's my ask of you. My ask of you is to go ahead and run 3 illustrations for your next GUL case. Go ahead and run the GUL, a Guaranteed Universal Life. Go ahead and run our Value Plus Protected using the current crediting rate, using the same premium, and using the same death benefit, and then run a dirt illustration running the Value Plus Protector at a rate of 4.5%. Show your client all these illustrations, and then let them choose. Do they want GUL? Do they want the Value Plus Protector? Or maybe even a combination of both. It really opens doors, and when you show them these illustrations, your client may be like, whoa, I didn't even think of this. I didn't realize that I can get this much. And then you can start breaking down some of those walls on your client that maybe just fixated on GUL, and you can offer them something that gives them a lot more flexibility, a lot more options. So that is the argument there for an IUL. Well, maybe an IUL may be a better fit or may offer your client more than a GUL can. Are there any questions out there that you may have? I know Sean mentioned that questions will be open to chat. So if there are any questions, definitely put those in the chat. And Sean, is there anything that you would like to add?
Well, I'm keeping an eye out for any questions. I'm not seeing any yet. So again, if anybody has any, now is the time to ask. By all means, no such thing as a silly question. Throw them up there. I did want to mention that concept of laying that 9% cap index over that worst performing period of the S&P is actually one of my favorite concepts for presenting IULs. And we actually have some hard copies of that idea. So if anyone wants any kind of materials like that, just let me know, and I can get all that out to you.
Great. Thank you, Sean. And so if there's not any other questions now, I'd like to thank everyone for joining us today. As Sean mentioned at the beginning of this presentation, this is the first in a series of IUL trainings. Next week on April 23rd at same time, 11 a.m. Central Standard Time, we actually will be taking a deeper dive into the Value Plus Protector IUL on there. So that will be a topic covered on the webinar next Tuesday.
Yep, everybody should have that invite. I would love to see everyone come out to that. Oh, and we did get a question, so hang off just for a second, Francisco.
Okay. No problem.
Next Tuesday, everyone should have that invitation. If you can't make it, not the end of the world, let me know, and I can get you that recording as well. Real quick, Francisco, what is the minimum age? What age do these products go down to?
They can actually go down to 0, actually. So you can actually, on the IULs, you can actually get someone, a newborn, a child, on here. When you start going to the better death benefits, the rating classes like preferred plus, that has a minimum age of 18. But anything like a standard, you can go as low as a newborn, 15 days old.
Perfect. Yeah, I know we've seen some pretty good concept kind of cells doing IULs on children.
Right.
We've got a couple other questions. Stephanie, are these single life plans, or can you do a couple plan like a survivorship plan? Do you have a second to die IUL at AIG?
Unfortunately, we don't. We actually did have those, and we discontinued that on the 29th of March. So it just happened a little less than a month ago. It's a way to just streamline our process and our product line. So as of right now, the ULs that we have are single life.
Perfect. And then the other question Stephanie had, if you have a minute, Francisco, would you mind explaining how these indexes work? The question was specifically, how long is the interest rate going to stay at a specific rate? Most of your indexes are annual point to point, right? Do you mind diving into that real quick?
Yeah, so we have different crediting options on our Value Plus Protector IUL. We have two indexes that are tied into the S&P 500, one to the Maryland Strategic Balance, and one to PIMCO, which is reaches the global markets. And all those, they're all available for 1 year segment terms. At the end of those 1 year segment terms, the client does have the option to reallocate their premium in a different crediting option if they like, or if they're happy where they are, they just take no action. And then when the new segment begins, everything just stays as is. And we're actually going to cover that a little bit more too in next week's webinars. We're looking deeper into the Value Plus Protector IUL.
Perfect. And Stephanie, if you have any other questions or anybody has any more questions on how these indexes actually work, by all means, give me a call and I'd love to have that discussion with you. Keeping an eye out for any other questions. We'll give these guys just another minute.
Okay.
In the meantime, if nobody else has any questions, thank you so much for coming out today. Can't wait to see you guys next week. And thank you so much for checking it out.
Thank you, Ron, for joining us. And Sean, thank you so much for the opportunity. Appreciate it.
All right, I think that's it for the questions. So once again, thank you all out for coming. Thank you, Francisco, for taking time to do this fantastic presentation. And I'll see you all next week. Thank you.
Thank you, everyone. Have a good day.